Welcome everyone to the live webinar, How to Build Wealth and Grow Fortunes That 99% of People Are Missing Out On. I'm Barry Brooksby, founder of Focus Wealth Group. And tonight we're going to discover how the rich think and what they do to make more money. I'm super excited to be here with all of you, and thank you for taking your valuable time tonight to learn. You know, by you being here, it shows that you have a desire to learn, that you want to grow, that you want more abundance and prosperity in your life. Tonight, you've taken action, so great job for being here. I hope you have a pen and paper and take notes, because, you know, schools don't teach what I'm going to share with you. I believe that people need to be taught these financial principles, and I hope that you'll share what you learned tonight with others. Just a quick bio. You know, I've been 18 years now in this financial services industry. I've seen a lot of highs, a lot of lows, have had great experiences. And along that same line, I've also spent 14 years in real estate. I have hundreds of clients across the country. Some of you are on the webinar tonight. I'm licensed today in, I think, 49 states. So it's been great to work with so many people across the country. And I've, run and owned multi-million-dollar companies. And I like doing that, of course. But again, what I'm most proud of is my family. My wife and I, we've celebrated 23 years of marriage, and we have 5 children, awesome kids. And some of you know I love to play guitar. I've been doing that for over 35 years and love to mountain bike. I'm here in St. George, Utah. I think it was about 60 degrees today, sunshine, blue skies, and it's just a great place for these outdoor activities, biking and hiking and everything else. Have you ever asked yourself this question? How does success happen? I used to have this thought in my early 20s that success was based on just one thing. And that if I could figure out that one thing necessary to be successful, then it would happen for me too. But what I've come to discover is that success is not based on just one thing. It's a conglomeration of many key things working together. And tonight, we're going to get to those key things. By the way, stick around to the end of the webinar because I'm going to give you the time and date of the next live webinar. And this next live webinar is going to be on real estate. If you have any interest at all in learning about real estate or making more money in real estate, you'll definitely want to attend the next webinar coming up in January. And yes, it will be live again. It will be about real estate, and I'm going to give you a ton of information that will boost your financial literacy about real estate. It's kind of a hot thing. People love real estate. So we're going to talk about that next month, and maybe even in February, might be a 2-part series. Now, before we go any further, a little housekeeping. Please turn off anything that's distracting you. Shut down Facebook, turn off your cell phone, put away any distractions. Really want you to focus. Let's dive in and learn how to build wealth and grow fortunes that 99% of people are missing out on, and discover how the rich think and what they do to make more money. Have you ever heard this before? Don't put all your eggs in one basket. Raise your hand if you've heard that before. Yeah, a bunch of you are raising hands. We've grown up hearing this. Why is this philosophy so popular? I'll answer that in just a minute, but first, I want to introduce you to this guy. This is Andrew Carnegie. He led the expansion of the American steel industry and was one of, if not the wealthiest man in the early 1900s. Very, very successful. We owe a lot to him for what he did in the U.S. steel industry and across the world. Well, here's what he said. don't put all your eggs in one basket is all wrong. He says, I tell you the way to become rich is to put all your eggs in one basket and then watch that basket. See, he's talking about focus. He's not talking about spreading yourself so thin where you've got eggs in many, many, many different baskets. He's telling us to focus. Put our eggs in one basket and then watch that basket. What we see too many people doing today when it comes to saving or investing money is they're relinquishing control. They have no idea what's going on with those dollars. Let me share a little bit of what I mean. Many of you have heard about the S&P 500 index. It's probably the most popular index in the US, maybe the world. And I want to show you this 10-year history because what's happening right now, the market is hitting all-time highs. I just saw yesterday on the news the Dow Jones had another record high yesterday. And the S&P 500 has hit several record highs. And so what people are feeling is, oh my gosh, I've got to get into the market. I've got to get my money working for me. The problem is this. I use this analogy. Imagine walking into the Lexus dealership tomorrow to buy your new Lexus, and the sticker price on the car is $50,000. But you say to the salesman, you say, you know what, I know it's 50 grand, but I want to give you 70. That's what's happening in the market right now. There's overvaluation and people are paying too much for stock. And we're going to see a problem. I don't know when, but I believe we will see a problem, another crash or a correction. So I'm going to bring up my calculator here. I want you to see this because so much hype is happening, yet what's really going on? So this is a 10-year history. And we're only going to look at this middle column, the S&P 500, from the year 2007 through 2016. So 2017 isn't over yet. We don't have the total numbers, but this is 10 years of history. And I'm going to copy these numbers because I want you to see what's going on. And look, I want to point this out. Look at 2009. It was a 23% return. 2010, 12%. 2012, 13%. And look at this, 2013, who wouldn't want to earn 29%? You look at these numbers and they look phenomenal. But watch this. We're going to take these same numbers and actually put them into a calculator. Paste the values here. And I'm going to click this button right here that says Show Rate of Return. And what we see is that the average rate of return over these last 10 years is only 6.45%. Isn't that crazy? That with a 23% return and 13 and 29 and almost 10% last year, you would think the average would be double digits, but it's not. It's only 6.4%, but we're not done yet. We have to put some real money into this because right now this is just math. This is 10 years, all the numbers added up divided by 10. That's all it is, 6.45. So when we now put money into this, watch what happens to the actual return. Let's use $100,000. So if you would have had $100,000 invested in the S&P 500 in 2007, your actual return, 4.67%. Now let that sink in for a minute. All the hype, all the records being broken, average over 10 years, 4.6%. And if we have a good year this year, maybe it will bump it up a few basis points, not much. It probably wouldn't even go over 5. But remember, this doesn't include any taxes or fees coming out. So it's worse. If we show a tax bracket of, let's say, 25%, I want to be fair about this. I know some of you are probably sitting in a 39% tax bracket, and some of you might be in a 20, but I'll keep it at 25. That reduces the return to 3.8%. And if you're in mutual funds in your 401k or your IRA, you have to pay fees. There are fees. And tonight, I'm not going to get crazy with it. I'm only going to use 1.5%. It drops it to 2.7%. Now, just a tangent, a side note here, go watch some of my other videos about mutual fund fees. 1.5% is low. There's Forbes articles and Bloomberg articles out there and videos I've done that show fees in a 401k or IRA are closer to 3 or 4%. So again, I'm trying to be fair. But look at this, 2.7% over a 10-year history. Probably not even outpacing inflation. So I bring this up because Andrew Carnegie said, don't spread yourself thin. Don't put money in all these different baskets. Who wants us to diversify? Really, who wants us to diversify? It's Wall Street and all these financial institutions. This is where we've learned this. Don't put all your eggs in one basket. This advice has come from Wall Street financial institutions. So I don't want to beat this to death, but when you look at this type of marketing, the idea is they want you to believe that when you put money with them, you're on this road to wealth, that you are going to be rich. And frankly, it doesn't work. If you look at the truly wealthy people in this country, they've primarily made their money in one of two ways. They've owned their own business or they've invested in real estate. Now, can you make money in the market? Sure. And some people do, but it's a rarity. And those that do are usually working in the market, and that's their job. So next, I want to introduce you to this gentleman. His name's Tom Wheelwright. Tom and I, we've not met, but we have a lot of mutual clients together, actually. And he wrote this book called Tax-Free Wealth. And we are now going to get into the meat of what I want to teach you tonight. And I first learned this from Tom. And it was so powerful, I've used it over and over and over again. And what we're going to get into are the 5 keys of the rich. This is where you want to take notes. Because if you will use these 5 keys, I promise you, you will not only make more money, but you're going to avoid a lot of pain and frustration in the future. You'll sleep better at night. You'll have so much more abundance and opportunity. The 5 keys of the rich are so powerful, yet so simple. You're going to walk away from this thinking, wow, it is very, very simple, but you have to apply it, right? The best things in life are simple, but we have to apply those types of things. We all know we should be eating right and exercising, but do we do those types of things on a consistent basis? So we have to apply. Now, for those of you that attended last month's webinar or you watched the replay, I talked about the 4 pillars of wealth. And I'm just going to go here real quick and then back to the 5 keys, because there was an overarching principle that we had to talk about before we got into the 4 pillars of wealth. And that is, you have to maintain control, right? So I want you to think about that, that perspective of control. I'm going to pull up my whiteboard because I want to write on this. So I want you to notice there are 3 arrows that are going up and 2 arrows that are going down. The rich increase 3 things and they decrease 2 things. The first thing they increase is they increase their control. Well, how do they do that? The idea is they want to make sure that they're in charge of decision making. They want to make sure they have ownership. They want to make sure that they're purchasing assets versus maybe a paper asset. They want tangible assets. They sit on the board. They have control. And they understand that when you relinquish control, the potential to lose money is much greater. They have control to make more money. Now, I brought this picture up of Ray Kroc. In this movie, I don't know if you've seen this or not, this is the story of Ray Kroc, the founder of McDonald's. And there's pros and cons about Ray. Some people like him, some people hate him. But as a businessman, he did really well. And the way he was able to build McDonald's was through control. He actually figured out a way to control the real estate. People ask, well, what business is Ray Kroc in? And a lot of people answer, he's in the hamburger business, or was. Well, that isn't true. Ray Kroc was in the real estate business because he owned the ground that McDonald's franchises were built on. And that enabled him to have control. By the way, he wasn't the founder. He called himself the founder, but McDonald's was actually started by two brothers, and he eventually bought them out. But Ray did what he did because of control. So we want to make sure that we increase control. Now, the first thing that the rich decrease is they lower and decrease their risk. Think about that. How much risk are you taking? And I'm not saying don't ever take risk, but you decrease risk. Use common sense. The rich, they use insurance. They hedge. They make sure that they are in a position to take the least amount of risk possible when it comes to their money. I love what Warren Buffett said. He said, risk comes from not knowing what you're doing. You better believe that the rich, they know what they're doing. And because of that, they lower their risk. Now, the second thing that they increase, go back to my green pen here, they increase their returns. They leverage. They have assets. They use the 4 pillars of wealth, like I showed you earlier. Again, if you haven't listened to that webinar or seen the webinar, go back to last month's webinar and check it out. They increase their returns. One of the ways we talk about leverage is you can not only leverage other people's money, like getting loans for business or for real estate and only coming in with a small portion of your cash, which increases your returns, but you can also leverage time. Why doesn't the doctor or physician spend time talking with the insurance company or handling billing, right? He has that hired out because it doesn't make sense on his returns. His highest rate of return is when he's in front of a patient, not doing charts or taking care of insurance billing. The second thing that the rich decrease are their taxes. Now think about that. How are you decreasing taxes? Some of you own a business. And by owning a business, that one move alone, you've lowered your taxes. And hopefully you have an aggressive CPA that's moral, legal, and ethical, but you want to be taking advantage of every tax write-off you possibly can. And the rich do this. They know how to pay less in taxes. I love what Donald Trump told to Hillary in the debates. Now, I'm not talking politics here, but what she said to him was, or the audience was, you know, Donald Trump only pays 15% in taxes, whatever number she threw out there, it was low. And his response was, that's because I'm smart. Well, what does Donald Trump do? What was he doing for work? It was real estate. It's not just Donald Trump. Most real estate investors pay very little in tax because real estate has tax advantages. It's a business. And most businesses, an LLC, an S Corp, a C Corp, have tax advantages. So you want to look at that, expenses, deductions, and also different types of investments. A Roth IRA has tax advantages. Cash value life insurance has tax advantages. I love what Robert Kiyosaki said about this. It's not how much money you make, but how much money you keep. And if you're having 30, 40, 50% of your income eaten up in taxes, you know what that feels like. So we want to put ourselves in a position to think, do, and act like the rich do. Lower our taxes. That's exactly what's happening. We want to hold on to more money. The fifth key is perhaps the most powerful. How is all of this achieved? Increased control, increased returns, lower risk, and lower taxes. The way this is achieved, the way this happens, is the rich increase their education. They increase their knowledge. If you're fearful about making an investment, guess what? Go learn about it. The more you know, the less risk you take. The more you know, the less fear you have, the more confidence you'll gain. Education is huge. And I'm not talking about the stuff you learn at school. I'm talking about coming to webinars like you are tonight, reading books by these people that have done it before. Look at the CEOs out there that have grown their companies that they own. The Amazons, the Googles, the Facebooks, the Microsofts, the Apples of the world. Look at their stories. They educated themselves and got very, very good at what they do, right? It became an expertise. So we want to increase our education, because when that happens, all these other things come to fruition. Now, raise your hand if you're still with me before we go on. Love it. Thank you. Love the hand raises. It's so good when you're on a webinar. Let's run a few different types of investments through the 5 keys and kind of see where they fall in. And you're going to notice this is a little different than the 4 pillars of wealth, how we were able to determine good and bad investments. The 5 keys of the rich really depend on that one in the center, which is this education. This is a key component. So let's talk again about a business. So if you own a business, how much control do you have? Do you have a partnership? Can you make the sole decisions? Is your business increasing returns? Are you marketing? Are you investing back into your business? Do you have an aggressive CPA that's lowering your taxes? And have you lowered your risk in your business? Those are personal decisions to ask. How about another investment? We hear about this one often, oil and gas. A lot of oil and gas investments, you relinquish control of your money. So you have to look at, where's the control? Am I in an LLC in that oil and gas investment that doesn't allow me control? That makes me think of another one here. Trust deed investing. I used to own a company. We did this in Las Vegas. And the investors that would invest money with us, their name would actually go on the deed for the real estate property rather than being put into a group LLC. And that allowed them to have more control. So we have to look at those types of things. How about stocks or mutual funds? How much control do you have? Do you sit on the board of the stock you're invested in? Probably not, right? You've got to look at that. And the problem with a lot of stocks and mutual funds is they're invested using 2 of the most popular investment tools out there, which are 401ks and IRAs, investment vehicles out there, I should say, which would be 401ks and IRAs. the taxes are deferred. That means you're putting off the taxes to some future unknown date. You nor I have any idea what taxes will be 10 or 20 or 30 years from now. So again, you have to run these through the 5 keys of the rich to determine. Now, I know I have a doctor client of mine. He makes as much money trading options as he does making money as a doctor. Well, he's educated himself on trading options. So he's in the market, but it's like a job to him. He's educated himself so well that he believes he can continue to make money trading options in the market. So again, I'm not saying you can't make money there, but you have to look at all 5 keys to determine, are you increasing the 3 and decreasing the 2? Let's look at a real hot one right now. How about Bitcoin? Or these other cryptocurrencies. They're so popular right now. And again, it's because they've had a lot of growth. They've expanded. Bitcoin is trading for around $17,000 right now for one coin. So you buy just a small fraction of a Bitcoin. Again, do you have control? Well, it's volatile like a stock or a mutual fund. It goes up and down. Could you have good returns? Potentially. No one knows what's going to happen. There's a lot of government regulation right now happening with Bitcoin. The risk, again, you lower risk by learning about Bitcoin. How is it traded? Who's using it? What businesses take it? All those things have to come into play. The one thing I do like about it is you can at least buy stuff with it, right? It is currency you can go buy, and more businesses are accepting Bitcoin. So I personally don't own any right now, but I might. I might own a small portion just to hedge. It's kind of like gold and silver, which I'll get to here. Gold and silver. I look at gold and silver as a hedge. Not necessarily an investment. I own both, gold and silver, but I'm not trading. I'm not buying and selling. I hold it for a hedge. It's like insurance to me. And I'm kind of thinking the same thing about Bitcoin. And maybe Bitcoin will go to $30,000 or $50,000 per coin, and I'll have my foot in my mouth. I don't know. But again, you have to look at these from a personal perspective. You have to get educated on these types of things. The last one I'll mention, we've talked about quite a bit, is real estate. And, I personally love real estate because I've educated myself about it. I first got involved in real estate back in 2003, and I've owned many single family properties. I've flipped land, I've flipped houses, I've done rental property. But I learned about it, and I've been burned in real estate. So it's not all warm and fuzzy. You have to get educated. But what I love about real estate is that almost right out of the gate, it can meet all 5 keys of the rich. You have control because it's a tangible asset. Hopefully you're cash flowing if it's a rental property, so you have good returns. It immediately lowers taxes just because of the nature of real estate. It's taxed differently. And the risk, well, yeah, the real estate market can go up and down, but it is a tangible asset. It's not a paper asset where you lose everything. And even in a down economy, people still have to live in a home. So whether rents go up or go down, you at least have a tangible asset. So I personally like real estate, and I believe almost out of the gate, it meets all 5 keys of the rich. And then the other one that I'm just going to, everyone here knows what I do with cash value insurance. The reason I love cash value insurance, and I'm going to put this one on top, cash value insurance, is because, again, this one, right out of the gate, almost meets all 5 keys of the rich. And I say almost because, you do want to make sure that you're understanding the education component, which you learn from me in my videos and everything else. But right out of the gate, you have control because of a guarantee. You know the return is going to be there year in and year out because it's not tied to the stock market. So we want to be in control, and cash value insurance gives us that. It's guaranteed, it's liquid, it's protected, and that money is growing and able to be used completely tax-free. Now, I'm going to come back to this in just a minute. I want you to take a look at this. So Ben Franklin, he said, an investment in knowledge pays the best interest. Invest in yourself. Invest in your own education. Invest in your knowledge. I've had the privilege to work quite a bit with Garrett Gunderson. He and I have, again, a lot of mutual clients across the country. And he said, invest in what you know. And that I've seen work time and time again. It's very rare for someone to lose money when they invest in what they know. This goes back to that increasing that last fifth key of education. So when you look at the 5 keys of the rich, as you're getting presented throughout your life with different opportunity, you can use this as a filtering tool to determine how it fits in your wheelhouse. And the more you know about something, the more you have these 5 keys: the control, the returns, the reduced taxes, and the reduced risk. It was Abraham Lincoln that said, the best way to predict the future is to create it. And by you learning and growing your knowledge, you'll be in a better position to create your own future. If any of you have ever thought about starting a business, go learn about it. I would encourage you to do it. I love owning businesses. If any of you are wondering, well, I'm working for someone else. I am a W-2 employee. How do I predict my future? How do I make more money? My answer is make yourself more valuable. And you'll find when you make yourself more valuable, people will be attracted to you. You'll find there's an opportunity somewhere, even perhaps within the same company, that you'll be able to grow and expand and make more money. But you have to make yourself more valuable. You know, money is an exchange of value. And when we receive money for services we render, it's a receipt. It's a receipt telling us that we have created value. Make yourself more valuable and go out and create more value. Now, I want to save a little bit of time here for some questions. Before we get to questions, and by the way, if you have some, you can type them into the chat box or the Q&A box. I'll check both and perhaps take a few questions. The next webinar, the real estate webinar in January, is scheduled for Thursday, the 25th. So that's January 25th. That's a Thursday, 6 p.m. Mountain Time, same time as we are meeting tonight. And that webinar, I want to talk about how to triple returns in real estate without taking more risk. We're going to talk about some real estate basics. So put that on your calendar, Thursday, January 25th at 6 p.m. If you have a question, type it into the question box or into the chat. Okay, one question here. I'll leave this open if there are others. What's the number one thing I can do to grow my business? Well, I would definitely encourage you to go back and watch the webinar last month, the 4 Pillars of Wealth. And what I talk about there is you have to increase cash flow, right? We're in business to make money, to increase cash flow. So the number one thing that you can do to grow your own business is to invest in yourself. You invest in yourself. You are your number one asset. You invest in yourself. And then by so doing, I promise you'll see relationships develop. You'll have insight and different ideas come to you when you invest in yourself, whether that's attending seminars, symposiums, webinars, listening to podcasts, reading books, talking to mentors, or even hiring a mentor. Invest in yourself. That is the number one thing that you can do to grow your own business. And I'm going to mention this because what I see too many business owners do is they get distracted by the bright, shiny objects, meaning they will have a friend or a business associate talk to them about this investment that's outside of their wheelhouse. And it sounds amazing. And so this business owner starts putting time, energy, and money into that bright, shiny object. And what happens? They lose focus on their own business. The bright, shiny object doesn't come to fruition. They don't make the money they thought, and now their business has been hurt because they took their focus off of their business. So focus on your business. It is your highest rate of return. All right, another question here. How can I best utilize the money in my existing cash value insurance policy? So for those of you that have cash value insurance and you're asking the same thing, the answer that I give kind of goes back to the initial question of how do you grow your own business, or how do you grow your business? And that is, with your cash value, I would find ways that you can invest in yourself. Let me give you an example. I have a client who is a chiropractor, husband and wife team. They live up in the state of Washington. And they use their cash value to do a couple different things. One, they use their cash value to buy some rental property. And all they did is they just used the cash value as a down payment on the real estate, and then they got a bank loan for the remaining portion of the balance. So 20% down from their cash value, 80% to buy the real estate. So they're still leveraging bank's money. The other thing that they did is, when we were having this conversation about the 4 pillars and 5 keys of the rich, they left the conversation and they started to brainstorm themselves. What can we do? What can we do? Well, what they did is they actually bought a couple lasers for their chiropractor practice. It was already something they knew. And these lasers help with treatment, help with patient rehab, weight loss, etc. And when I spoke with them just a few weeks ago, they said, wow, we haven't even started advertising the lasers. We've just been marketing to our own patients, and we're killing it. We're making tons of money. So they're using their cash value again to reinvest back into their own business, back into themselves. That is the best way to utilize the money. And if you have specific questions about that, I'm going to pull up this screen here. If you want to schedule an appointment or visit about some of those types of things, feel free to reach out to me. Either through email or phone. You can talk to my assistant, Jody, and she can get you scheduled on my calendar. So thanks to all of you for taking the time to spend watching the webinar this evening. Again, it shows your dedication to wanting to learn to create abundance. Use the 5 keys of the rich as a filtering tool to make the best decisions possible. Stay in control. And you'll find as you stay in control, you will make more money. You'll be able to do what the rich do, build wealth, grow fortunes, and have much more than you otherwise would have had. Thank you again for attending the webinar, and hopefully we'll see you back here next month in January. Merry Christmas and Happy New Year.